One company turned US Treasuries into 24/7 digital tokens. Another let people in Nigeria trade Apple stock like Bitcoin. And guess what? They don't need a bank at all. Tokenized assets are exploding worldwide, and these some shocking examples show why regulators are panicking. Stay for the final one. It's already happening, and no one's ready. Let's start with Chapter 1. Tokenization is real, but does it actually solve anything? The year is 2008. A $700 billion bailout hits Wall Street while regular families lose homes by the minute. Yet no one questions why financial assets, stocks, bonds, debt, are still running on tech built before the iPhone. That same year, Bitcoin quietly appears online. Not as a stock, not as a company, as a protocol, a system. And that system would plant the seed for tokenization, turning traditional analog assets into living, programmable software. But let's not get ahead of ourselves. What even is tokenization? In the simplest terms, it means taking a real-world asset, like a share of Apple, a US Treasury bond, or a Manhattan condo, and turning it into a digital token on a blockchain. Not a derivative, not a promise, a cryptographically backed, legally tied real representation of the actual asset. You can transfer it, trade it, use it as collateral. All without a broker, banker, or a closing bell. Sounds clean, but why now? Well, did you know that in 2024, nearly $1.3 billion worth of US Treasuries were already tokenized and traded on-chain? And according to the World Economic Forum, 10% of global GDP is projected to be tokenized by 2030. But here's what most people miss. Tokenization isn't about crypto. It's about freeing assets from legacy rails. And once they're free, they act differently, they move differently, and they make new things possible. Things Wall Street never wanted you to try. Why did BlackRock copy the model of a tiny tokenized fund? Why are banks quietly rewriting infrastructure plans behind closed doors? That's the twist no one expects, and what will peel back next. Because the real question is, if tokenization sets assets free, who's still trapped behind the old gates? Moving into Chapter 2. Why most of the world can't actually access US markets. Imagine a 19-year-old in Lagos trying to buy Apple stock. Now picture a Wall Street trader doing it in 0.8 seconds from a Goldman Sachs terminal. Same stock, same ticker. Two different realities. We like to believe the US stock market is open to everyone, but here's the truth. Unless you're inside certain borders, hold a particular passport, and have a very specific kind of bank account, you're locked out. And if you try to get in, you'll pay dearly. Let me give you an example. In Brazil, accessing US equities through a local brokerage often carries a 5 to 10% conversion fee, plus spreads. In India, converting rupees to USD, wiring the money, and buying the stock can take days, if not weeks, and costs $50 to $100 just in compliance processing. In Turkey, where inflation hit 61.5% in 2022, many tried to shift their savings into dollars or US stocks, but local capital controls made it nearly impossible. So they resorted to crypto rails. Sound familiar? That's where tokenization walks in. Platforms like Ondo Finance allow you to buy a token that legally and operationally represents a US Treasury bond from anywhere, using stablecoins like USDC, no banks, no borders, no opening hours, and it's not just theory. In 2023 alone, over $200 million worth of tokenized US bonds were purchased by wallets in Nigeria, Vietnam, Argentina, and Lebanon, places where traditional banks actively block or limit foreign investments. Here's the kicker. Over 1.7 billion people worldwide are underbanked, or have no access to capital markets at all. But almost all of them now have a smartphone. And now that smartphone can hold Apple stock if it's tokenized. But wait, how do we know the token really represents the real stock? What if the price drifts? That's the storm we walk into next, because the truth is, once assets move to new rails, the old rules of price, trust, and value don't always follow. Next is Chapter 3. If stocks already work, why put them on a blockchain? Picture this. You buy Tesla stock on Robinhood for $420. Now try sending it to your Coinbase account. You can't. The stock's locked in. We live in a world where your money moves like the internet, but your stocks move like it's still 1975. Even inside the US, brokerage platforms are a maze of walled gardens. Fidelity, Schwab, Robinhood, E-Trade, they all play by slightly different rules. Some let you trade after hours, others don't. Some let you borrow against your stocks. Others trap them inside the account. Most people don't realize this. Your stock account isn't really yours. You don't own the shares directly. They're held by a clearinghouse like DTCC, then loaned to your broker, and you only get synthetic exposure. Now compare that to how crypto works. When you hold a tokenized asset, like a tokenized Apple share, it lives in your wallet, not a third-party custodian. You can transfer it instantly, 24/7, use it as collateral, even automate trades or borrow against it on-chain without asking anyone's permission. Why does this matter? Because in March 2020, the US stock market shut down 4 times in 1 week due to extreme volatility. Meanwhile, crypto kept trading globally without pause. That's not just technical superiority, that's resilience. Another wild stat, in 2023, over $2.4 billion worth of DeFi loans were issued using on-chain collateral. Things like stablecoins, tokenized treasuries, and even synthetic stocks. No banks, no branches, just smart contracts. Still think stocks don't need fixing? Here's a quote from SEC Chair Gary Gensler in 2022. "Settlement takes too long. Transparency is limited. Investors deserve better." The irony? He's saying that about a system that settles trades T+2 2 days after you click buy. Tokenized assets settled in under 10 seconds. But here's the catch. All of this only works if the tokenized version stays true to the real thing. What happens when it doesn't? That's not a hypothetical. It's already happened. And the fallout is ugly. Onward to Chapter 4. Why tokenized assets keep breaking and how to fix it. Imagine buying Tesla stock for $420, only to find it's trading at $450 somewhere else, on-chain. But wait, why is the same stock priced differently in 2 places? That's called depegging, and it's one of tokenization's biggest problems. Here's what's really happening. When you tokenize a stock, you're creating a digital mirror of a real-world asset. But if that mirror isn't tightly connected to the original, the reflection gets distorted. Fast. Let's rewind to 2022 when several platforms began issuing tokenized stocks. Everything looked fine until users noticed their tokenized Google or Tesla shares weren't matching the live price on the NASDAQ. Sometimes the price was 10% higher or lower than reality. That's not just annoying, it's dangerous. Just like stablecoins need to stay at $1, tokenized stocks must match their real-world price, tick for tick. If not, you can't trust the value, can't trade with confidence, and can't use the assets safely in DeFi. Why does this happen? Because most on-chain versions of stocks use EX decentralized exchange liquidity pools. These are built from user deposits, not directly connected to the NASDAQ or NBSE. Without live data feeds and instant redemptions, prices drift. This is depegging. And there's a bigger issue. There's often no easy way to redeem your token for the real stock. With no link back to the source, arbitrage breaks. And that opens the door for manipulation. Here's a scary stat. By late 2023, over $150 million worth of tokenized assets on smaller platforms had been depegged, some by as much as 20%. In several cases, users were stuck holding worthless tokens they couldn't redeem. So, is this the end of tokenization? Not quite. Companies like Ondo are building real-time bridges, systems that execute trades off-chain and mint/burn tokens on-chain simultaneously. That way, the price always stays pegged, and you can redeem anytime in full. BlackRock's tokenized bond product took similar steps in 2024, copying key elements from Ondo's playbook, including built-in redemption pools and off-chain liquidity sync. Because here's the hard truth. Tokenizing is easy. Keeping the token trustworthy is the real game. And while that tech puzzle is being solved, another battlefield is opening up. Because Wall Street and DeFi, they're about to collide. Now we get into Chapter 5. Can Wall Street and DeFi actually work together? A 200-year-old bank meets a DAO made last week. One speaks in compliance clauses, the other moves billions with memes. You'd think they're enemies, but behind closed doors? They're quietly shaking hands and drawing battle lines. Let's go back to 2016. Ian DeBode, now at Ondo Finance, was at McKinsey talking to old guard French bankers about blockchain. Not crypto, just blockchain. They laughed off Bitcoin. They were curious about digital ledgers. Fast forward to 2024, and BlackRock is issuing its own tokenized bond fund. JP Morgan is running transactions on blockchain. Goldman Sachs has its digital asset platform. Even Citibank said in an internal report, the tokenization of financial assets could be the defining transformation of the next decade. But here's the twist. They're not trying to reinvent finance. They're trying to control how it evolves. See, most big banks want tokenization inside permission systems, walled gardens, private chains. You can't move the assets freely. You need to ask for access. That's not very DeFi. Meanwhile, projects like Ondo and Centrifuge are building tokenized treasuries that move freely across Ethereum, Avalanche, Solana, and more. Their goal? Real freedom of movement, real composability with DeFi, real 24/7 finance. But Wall Street's not wrong to be scared. According to BIS data, by Q1 2024, over $3.1 billion in real-world assets, RWAs, were on public blockchains. Most of that happened outside bank control. And regulators? In early 2024, the U.S. Treasury released a report acknowledging the need to onboard U.S. capital markets onto public blockchains, in part to maintain dollar dominance in a world rapidly embracing crypto infrastructure. It's the same logic behind stablecoin regulation. If the rails are moving overseas, bring the power back home by supporting it early. That's why Ondo's conversations with regulators have been so positive, because America doesn't want to lose this race. But there's a price. If the US opens the floodgates for on-chain tokenized assets, will people start expecting everything to earn yield? They already are. And the next shift could replace your savings account before you even notice. Let's dive into Chapter 6. Does yield-bearing money replace traditional savings? What if holding cash earned you 4.3% every day automatically without a bank? For millions around the world, that's no longer a what if. It's already happening. Let's rewind to 2020 when global interest rates were near zero. Banks paid 0.01% interest on your savings, literally 1 cent per $100 per year. That same year, Tether, a dollar-backed stablecoin, crossed $20 billion in market cap. But here's what people didn't realize. Tether made billions on the yield from US Treasuries and passed none of it to users. They held your money, they earned the interest, you got nothing. Now fast forward to 2023, platforms like Ondo launch USDY, a yield-bearing token backed by short-term US Treasuries. It pays out 4.29% APY daily, no minimums, no bank accounts, just hold the token in your wallet. In just 1 year, USDY and OUSG, Ondo's earlier treasury token, grew to 700 million AUM across 10 blockchains and over 100D EFI protocols. The money market fund just went permissionless. And here's the kicker. The majority of these buyers aren't in the US. They're in countries like Argentina, Nigeria, Lebanon, places where local currencies collapse regularly. In Argentina, inflation hit 211% in 2023. A yield-bearing stablecoin isn't just nice, it's life-changing. Even in the US, money market funds hit a record $6 trillion in 2024 as people fled banks for higher yield cash alternatives. So what happens when billions realize you don't need Chase or Wells Fargo to earn safe yield anymore? And what if those yields flow 24/7 either across protocols, wallets, DAOs, and apps? Willie, it's already begun. The line between savings and investing is disappearing. But this isn't just about earning yield, it's about control. Because if your money moves freely and earns a yield, who controls it? Let's follow that thought and watch it lead us straight into the future of time. Let's continue with Chapter 7. Will people really trade stocks 24/7? A war breaks out in the Middle East. Crypto crashes by midnight. Stocks still asleep. Why? Because they're not allowed to move after 4 p.m. The market's closed. That might have made sense in 1915 when trades happened on paper and phones rang manually on trading floors. But in a world where news breaks on Twitter and wallets work on Sundays, why can't your money move too? Let's break this open. The New York Stock Exchange still runs on market hours at 9:30 a.m. to 4 p.m. Monday to Friday. That's just 32.5 hours per week. But crypto open 168 hours a week, nonstop, globally. The 2022 Luna crash happened overnight, wiping out $60 billion in a matter of hours. Traders responded instantly. Algorithms deployed capital, people hedged losses. Meanwhile, when Silicon Valley Bank collapsed in March 2023, the US stock market was closed over the weekend. Depositors panicked. But they couldn't move their money. They had to wait. The market reopened 45 hours later. Imagine knowing your savings are at risk, but being told you can't act. Not until Monday. That's the core issue tokenized assets challenge. If your Tesla stock is tokenized on-chain, it can react to news, trades, and arbitrage in real time. No weekend gaps, no frozen funds, no waiting. Already in 2024, Ondo's tokenized equities project is building toward 24/7 on-chain trading of US stocks using real-time pricing, automatic settlement, and DeFi native collateral. And the demand is growing fast. According to a Charles Schwab survey, over 62% of Gen Z and millennial investors say they'd prefer 24/7 stock trading if it were safe and available. But here's the twist. This isn't just about convenience. It's about who gets access to volatility and who gets stuck in silence. Because right now, hedge funds can trade pre-market and after hours. Retail can't. So who benefits from the delay? And once everyone can move assets anytime, anywhere, what happens to the old system of gates and clocks? Let's answer that with one last question. What if the real risk isn't the tech failing, but trust itself collapsing? Let's close with Chapter 8, What if tokenization fails after all? Every revolution has a chance to backfire. So what happens if this one just doesn't work? What if the dream of 24/7, borderless programmable money dies before it even starts? Let's get honest. Tokenizing an asset is technically easy. Any developer can do it in a weekend. But making that asset usable, trusted, and superior to what already exists, that's the real mountain. The biggest risk isn't regulation, it's not price crashes, it's not even Wall Street, it's bad UX. Right now, to hold a tokenized stock or yield-bearing coin, you need a wallet, a seed phrase, onboarding, KYC. And for most people, even in 2025, that's overwhelming. They're used to Robinhood and Fidelity, slick, smooth apps with tap-to-trade features and FDIC badges. Ask them to custody their own funds and sign blockchain transactions, you've already lost them. In fact, according to a 2024 Coinbase survey, over 67% of crypto-curious Americans say they've avoided blockchain-based investments because the user experience felt confusing or risky. This is the silent killer. And if platforms like Ondo, Bakkt, Matrix Stock, and BlackRock's tokenized arms can't deliver something simpler, safer, and more powerful than Web 2, the market will walk away. Forever. Because here's the paradox. People don't care if something is on-chain. They care about what they can do with it and how fast, easy, and safe it feels. The future doesn't belong to the best protocol, it belongs to the best experience. That's what makes Ondo's approach interesting. Their latest models are abstracting away the blockchain entirely. To the user, it feels like a better brokerage, not like a crypto product. And maybe that's the answer. Hide the rails, keep the benefits, earn the trust. But if that doesn't happen, tokenization fails. Not because the idea was wrong, but because we didn't package it right. And if that happens, we go back to bank branches, settlement delays, and 0.01% yield. because we couldn't convince people to walk one step into the future. But here's a final twist: even if it fails today, it won't stay dead forever. The idea is out, and ideas, once released, don't vanish. If this blew your mind, imagine what else we're uncovering. Hit that like button, subscribe for more deep dives into the future of money, and don't miss the next video. We're just getting started. The revolution is on-chain, and it's only beginning.